Hey, in this video, I'm going to talk about assets location strategy. Just keep in mind, this is a very sophisticated investing strategy, incorporate taxation in it. So basically, you have to understand all kinds of different investment, how those investment being taxed, how different accounts works. So you really require you have a substantial investing taxation experience in order to understand this strategy. So I will try my best to explain it. This will give you an overview, so you will know why we need this strategy, why it's so beneficial. Then first, what is asset location strategy? Here says asset location is a tax minimization strategy that takes advantage of different types of investment, getting different tax treatment. Using this strategy, an investor determines which securities should be held in different accounts, such as tax-deferred accounts or taxable accounts, to maximize after-tax return. You can see this involve, different investment, how investment being taxed, then how different accounts works. So let's dive in. Basically, why we wanted this strategy? Very simple. We want to pay less taxes, especially we want pay less taxes during our retirement. How and where you invest your money today will impact your retirement income in the future. So this is very important, especially you are young, still accumulating your assets, investing, for long term for your retirement. This is very important for you to understand. So once you retire, your assets, investment, in different accounts, there will be some of them is tax-free. Then some is going to be taxed at the long-term capital gain rates. Some going to be taxed at ordinary income. So tax-free, of course, is always better being taxed at the long-term capital gain rate. However, being taxed at a long-term capital gain rate is much better than being taxed at ordinary income. So basically, because all those tax implications here, so that's why we need a plan. Planning your investment in different accounts. So let's see type of accounts. Tax-free, not taxed accounts. Roth IRA, Roth 401k. So those accounts, whatever investment you put in. So for long-term, your investment, can double your investment, 3 times of your investment, do tremendous gains. All those gains in those retirement account will be tax-free when you retire, withdraw those investment. So this is the very, very ideal place to place your investment in it. Then on taxable accounts, you want to know they usually being taxed as a long-term capital gain if you hold your investment in it long-term. Those are usually a brokerage account and a taxable trust. So the last one is ordinary income tax deferral account, 401k, traditional IRAs, so any pre-tax money. So those account, no matter if those investment is generated capital gain or just paying dividends or interest, everything inside you in this account coming out will be taxed as ordinary income. Okay, let's look at it. This is a different type of tax rate based on the investment. So it's more like, what type of investment being taxed as a long-term capital gain. What type of investment is taxed at an ordinary income tax rate? Here, why first just a quick look at it. Why long-term capital gain rate is better than ordinary income tax rate? You can see the bracket. For long-term capital gain, 0%, 15%, 20%. Maximum is 20%. For ordinary income tax rate, so it basically is exactly like your paycheck, your salary, wages. This is the federal tax bracket. The highest is 37%. You can see long-term capital gain is taxed at a much lower rates. Then also, just keep in mind, if it's you make money, the same amount of money, if it's long-term capital gain, you will pay much less tax. If it's ordinary income tax. Just keep in mind, long-term capital gain is always better than ordinary income tax. So that's period. Then what type of investment generate, long-term capital gain? And so like stocks, funds that held more than a year. So those usually the gains will be taxed at a long-term capital gain rate. Also for qualified dividend, which is the dividends paid by those stock and funds held more than a year. So there are qualified dividends. Okay, so the period actually is a little shorter than a year, so it doesn't matter. So if you hold those more than a year, so the dividend will be qualified dividend. So just keep in mind, long-term capital gain and qualified dividends are taxed at long-term capital gain rates. Another category called collectibles. Especially like a gold, you buy gold ETF or silver ETF, those things, their long-term capital gain, the highest bracket is a little higher than the ordinary 20%, so they are 28%. So just keep in mind, have a little different category here. Otherwise, everything else is going to be taxed at those long-term capital gain rate. For ordinary income, what type of investment can be taxed at ordinary income? For your stock funds that held less than a year, so when you have a gain, those will be short-term capital gain. Short-term capital gain is taxed as an ordinary income tax rate. Then the interest income is taxable. Usually from your taxable bonds, like I'm going to talk about bonds a little bit later. And so taxable bonds like corporate bonds, they are their interest paid by those bonds are taxed at ordinary income. Other thing is non-qualified dividends, especially one category is REITs, real estate investment trust. Actually, many investors, they invest in the real estate in the stock market. So those real estate investment trusts, they are required to pay out dividends. So those dividends is non-qualified, so is taxed at ordinary income tax rate. So that's just something. Also, if the dividends was paid by those stock funds you hold less than a year, those are non-qualified dividends as well. So basically, those type of investments will be taxed at ordinary income tax rate. So what you want to do is you want a long-term capital gain, those investment placed at a taxable accounts like a brokerage account, and you want those investment placed in your tax deferred account like traditional IRAs or your solo 401ks. So yeah, that's just something why different investment should be placed in different accounts. That's the tax implication on it. I just want to dive a little deeper to show you how bonds are taxed. If it's just taxable corporate bonds, so their interests are taxed ordinary income. Then you just keep in mind bonds are traded on the stock on the bonds market. So when you buy low, sell at a high, generate gains. So those gains will be short-term and long-term capital gains. So those are corporate bonds, right? Then you have a government bonds. There's federal level and the municipal bonds. So federal bonds, no matter federal bills, federal notes, those are the same thing. The interest usually states local income tax exempt. And for you buy low, sell high, generate a gain, those will be short-term and long-term capital gains. So it depends on how long you hold it. Municipal bonds, the interest is federal income tax exempt. The same thing, you buy, sell, at a gain. So those will be short-term, long-term capital gain. So those are just the same thing. Nowadays, many people just hold bonds, ETF, and mutual funds. Those are exactly taxed similar to the individual bonds. Just depends on how the mix of the with all those category bonds in it. So maybe portion of it will be tax exempt federally or states. So sometimes just keep in mind, otherwise bonds interest are taxed at ordinary income tax rate. So that's the bonds. Here is a summary list actually from Charles Schwab that talk about exactly the same subject, which is assets, location, different investment in different accounts. So for taxable accounts, they say ideal is for those type of investment. Look at those investment say individual stock you plan to hold more than a year. They generate long-term capital gain. Those generate long-term capital gain as well. So when the investments generate long-term capital gain qualified dividends, you want to place them in the taxable account, which is like an ordinary brokerage account. For all the municipal bonds, federal treasury bonds, you may place in those taxable account as well, because you don't pay tax on on the federal or in state income tax. So that's something. For tax advantaged accounts, like your 401k, traditional IRA, those just keep in mind, any investment, they generate short-term capital gains. They generate long-qualified income dividends or interest, or those things, you should place them in the tax deferred accounts. Another thing I forgot to mention for the Roth IRA, Roth IRA, you can play any of those in the Roth IRA. That is assets location strategy.